Benjamin Graham did not build a stock-picking formula for social media. He built a discipline for avoiding permanent loss. Today, investors can screen thousands of companies with artificial intelligence, but speed does not replace judgment. In this video, we will walk through 13 Graham-inspired checks used by Terminal Investor, explain what each one is trying to protect you from, and show how the checks combine into a research score rather than a buy signal. The first group concerns business durability. A long record of positive earnings shows that a company has operated through recessions, rate changes, and competitive pressure. A dividend record can provide another signal of financial discipline, although it is not suitable for every industry. Earnings stability matters because a low price-to-earnings ratio built on one unusually good year can be misleading. The scoring system looks for repeatability, not just a single attractive snapshot. Next, examine the engine behind reported earnings. Revenue should be durable enough to support the business across cycles. Margins tell you whether the company has pricing power or is competing away every dollar of value. Free cash flow tests whether accounting earnings turn into cash after the company funds operations and capital spending. When revenue, margins, and cash flow all deteriorate together, a cheap valuation may be a warning rather than an opportunity. The balance sheet is where many value traps reveal themselves. Debt can magnify returns when conditions are good, but it can eliminate shareholder value when refinancing becomes difficult. Liquidity asks whether near-term obligations can be met without emergency financing. Interest coverage asks how much operating profit remains after debt service. Terminal Investor treats these as risk gates because an apparently undervalued company has little margin of safety if creditors control the timetable. Graham is closely associated with low valuation multiples, but the important word is normalized. Earnings can be temporarily inflated, depressed, or distorted by one-time items. Book value is more informative for banks and asset-heavy businesses than for software firms whose valuable assets may not sit on the balance sheet. AI can calculate ratios instantly, but the research process still needs context. The score therefore treats valuation as evidence to investigate, not a reason to purchase by itself. The final checks ask whether management has historically converted capital into useful returns and whether the current price leaves room for error. A margin of safety is not a precise number delivered by a model. It is the gap between a conservative estimate of business value and the market price, adjusted for uncertainty. Terminal Investor also surfaces risk flags so a high aggregate score cannot hide a serious issue, such as excessive leverage or collapsing cash flow. The practical advantage of AI is consistency. The same questions can be applied to thousands of companies without fatigue or headline bias. Terminal Investor ranks candidates, explains which checks passed, and highlights missing data or risk conditions. The investor still reads filings, evaluates industry structure, and decides whether the assumptions make sense. The correct workflow is machine-assisted triage followed by human due diligence. A useful score should make your next questions clearer. Why did a company fail the cash flow check? Is leverage temporary or structural? Does a low multiple reflect fear, cyclicality, or genuine deterioration? You can inspect a sample Terminal Investor report and run the same structured screen during the free trial. Use the output as the beginning of research, never as personalized financial advice or a promise of returns.